Here's part 4 of our Chapter 5 video lecture with the next category of itemized deductions reported on Schedule A. And that's the interest that was paid during the year, beginning here in line 8. Line 8 is one category of interest called home mortgage interest. And the other category here in line 9 is interest we pay for money we borrowed for investing. Now, in the case of the home mortgage interest, most times the interest will be reported to the taxpayer by the bank on this form called 1098. Here's an example of a form 1098. Here would be the name of the bank or the lending institution, and here is our taxpayer. And here in box 1 would be the amount of interest that was paid during the year. And there's different limitations in the amount that you can deduct. One is based upon the amount of the money borrowed, the dollar amount, not the interest paid, but the money borrowed. And another is the date the money was borrowed. Another type of related deduction is the mortgage insurance premium that is being paid to the bank or to the lender. Let's take a look at the back again on the Schedule A. So in the case of the home mortgage interest, that's the interest paid during the year, and also something called points. Points is extra prepaid interest paid up front when you borrow the money. So that should be probably included on the 1098 form. If it's not included on the 1098 form, then you would report it down here in line 8C. And also, if you refinance, you borrow money to pay off an old mortgage and you pay those points, you may have to spread the deduction of the points over the life of the new loan. Again, we call that amortized, and that would also be reported down here in line C each year that you amortize those points. The limitation is based upon the amount you borrow. So there's a couple different, maybe 3 different limitations. One is $1 million amount borrowed, but the current limitation is 750,000 amount borrowed. So if you borrow more than that, you cannot deduct any interest on a loan that's greater than 750,000. That's for loans beginning, I believe, in 2018. Prior to that, the loan limitation was $1 million. Now, this can be for both your primary home and a second home. We're not counting rental property. We're not counting business property now. That's going to be covered next semester in our Accounting 137 class. But here for your personal residence and a second residence, you can borrow up to currently $750,000 loan and deduct all of the interest. The type of interest is called here on this publication 936, where you need to, if you need to find more information, we call this home acquisition debt. That means you're borrowing money, that's debt, and you're acquiring your home, you're buying your home, you're constructing your home, you're making improvements to your home. Maybe it's a leasehold property and you're buying the land, the fee interest. If you borrow money and use it for other reasons, like purchasing an automobile, taking a vacation, paying tuition, paying off credit card bills, that type of borrowing doesn't count. The interest you pay on that type of loan is not deductible, even though it may be what we call a mortgage. Mortgage meaning the lender can foreclose on your home if you don't pay them back. But the money has to be used for acquisition costs. Again, buying your home, constructing your home, in making improvements to your home. Okay, so if you borrow for more than that, the interest is not deductible. And again, if you borrow more than 750,000, the excess interest on over that $750,000 loan is not deductible. Again, there's different loan limitations. $1 million limitations for loans that were grandfathered in prior to 2018. Again, the current rule is 750,000. So back here on the Schedule A, the main interest and points would be reported here in line 8A. Now, if you borrow money not from the bank, but from the person that sold you the property, you would report the interest paid over here and the contact information over here. Mortgage insurance, this deduction was brought back last minute for 2019. And again, if you take a look at the 1098, there may be a box showing how much insurance you paid to help the lender guarantee your loan. And whatever dollar amount here could be deductible, assuming that the taxpayer, the borrower's AGI, is less than 100, I believe it's 109,000 or 110,000. If your AGI is less than 100,000, then all of this mortgage insurance premium should be deductible. If it's above that, it'll get phased out and totally phased out if your AGI is above $109,000. And again, that's reported here in line 8D, mortgage insurance premium. The other category of interest is reported on this form 4952. That's when you borrow money and use the borrowed money or proceeds for investing. And you get to deduct the interest on this type of loans only to the extent you have made money on those investments, like interest income or dividend income, or maybe even the gain when you sell your investments. There's a limitation in terms of how you treat this income. So that again is reported on this form here. Not too common, but typically the type of interest that can be deducted here is sometimes called margin interest. You're borrowing money from the broker where you're purchasing these investments. So you would total up all of these interest deductions, and then here in line 10 would be the total for this category. And if you have a home mortgage, this may be the largest deduction you have. We saw that back here in line 7, it could be limited for taxes being deducted maybe up to a dollar limit of 10,000. So typically, if you do have a mortgage, this is the main reason why you're going to be claiming so-called itemized deductions versus claiming the standard deduction. Okay, so let's move on to the next video where we're going to be covering charitable contribution deductions.